Meanwhile, gold, silver, uranium, oil, they're just going bonkers.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers.
Okay, guys, welcome back to another episode of Talking Trades with myself, Kevin Wadsworth, and my friend and colleague, Patrick Karim. Okay, guys, stock markets. Well, they can be frustrating sometimes, can't they? I mean, holding stocks from 1966 through to 1982, I don't think that was a very pleasant experience, Pat. We can use technical analysis, I think, to give us some pointers how to avoid that kind of pain. Do you want to talk about the pain there and how we could have avoided it?
People, Kevin, they have short-term memory. It's not their fault if you're not like chart geeks like us, and you look at past data, not just a Yahoo chart where they show you 6 months of data. A lot of data to see previous macro cycles. You just can't see that. The only thing you'll hear about on X or on social media will be something's happening in the Middle East, price dumping, Fed has to do that. It's like, it's fine, I guess, short term. The price doesn't have to react like that, right? Because remember, good news in the bull market is good news, but bad news in the bull market is also good news. But you got to flip that. Good news in the bear market is bad news, and bad news in the bear market is bad news. What does that mean? That means it's the price that does the talking. It's the aggregate of market participants that does the talking, right? Is the price trending upwards, sideways? It's all the news events, all the analysts, all put together. That's what you get in the price chart. Why did I want to focus? And guys, I'll be showing you the chart real soon. Why did I want to talk about what happened in the 1960s, late 1960s to 1982? Because people like the noobs, the traders there, anybody like who just like 2008, Kevin, it's like what, 17 years ago. They just know an uptrend. They've never seen a downtrend, right? Some people saw the 2001 drawdown, the 2008 drawdown, and very, very, very few people have ever traded or saw the 1970s moves. Okay, I hope you guys see that. I'm going to show you, we're going to deep dive what actually happened in the 1960s, guys. And I'll show you right after this chart. I'll show you what happened, which makes this performance of the Dow Jones even worse than what y'all actually see. You're seeing right here. So what you got here, you have the Nifty 50s. I'm repeating that because that's something that I read, but Nifty 50 could do no wrong. The whatever IBM, Xerox, it's like to the moon. So some of the narratives we could still be hearing today could do no wrong. And after that, okay, 23% correction, 1965. Fine, market rallies, but markets aren't able to surpass that. So what does that mean? It's developing some type of congestion area right above that. If you can't break up to the upwards to the upside, eventually you got to be wary of these support higher lows. And if that fails, oh boy, something else happened. So 23% correction, then you get a 30% correction. And why that makes it worse, guys? Because the price went sideways, my rising trend lines here, 1, 2, 3, 4, like super valid rising trend line. Once I've broken down, it's not a 20% correction you get something more nefarious until you reach further away support levels. So now you went sideways from 66 to 68, 2 years, nothing. And now 1970, you're even down the hole. You're down 30% from there. All right, we get the rally, man. Rally time goes up. You get almost looks like a breakout here, but just happens that if you'd be looking at the stocks, you should have ratio charts. You would have seen that gold's outperforming the SPX probably at that moment. Silver's outperforming the SPX or the Dow. Oil's outperforming the Dow. So this breakout here in the Dow was a false breakout, and it happens. So it didn't have the full weight of evidence to continue upwards. So what happens once you realize that you get a close below that? Well, you have to step aside because now 1, 2, 3, beautiful rising trend line, breakout to the upside, failed, moved downwards, super nefarious. Like that's not something you want to see. And guess what? Bam, 40% drawdown. That's like, and now we're talking from 1966, it's almost end of 65, 66, to 72, nothing. And now you're back in 74. So you're 8 years later and you're 40% down the hole. That is just bonkers, guys. Just bonkers. All right. Rally time. Beautiful. You get a beautiful, and you see these today, like in the bull market, these continuations here, often they continue upwards, but guess what? It halted slightly below previous highs. Can't break out. There's a little line here. Can't break out. And guess what, guys? Yeah, 26% drawdown. And meanwhile, gold, silver, uranium, oil, they're just going bonkers, outperforming the Dow. They're never letting go, right? Because this last 2 years here until 1980, that's when silver and gold really went bonkers. So 26% drawdown. We're back 78. We're 12 years later. Nothing. No bueno. Just terrible. All right. 1, 2, 3, 4. Breakout here. Is that the breakout that's going to lead to a new bull market? Well, guess what? Look where it halted. Right here. I could even stretch that line now. So now I have 1, 2, 3. No bueno. It didn't go up, guys. Rising trend line, support break, and guess what? Another 20% down. So now, all the way down here to 1982, since 1966, sideways move, and you're still 20% down until finally you get a big, huge pattern. And look at that. Higher lows was morphing, but now higher highs, and that's off you go. This is, from 1982 all the way to 2000, 2001. That was the bull run, the legendary bull run for U.S. equities. All right. I just want to show you something now to really showcase what happened to the Dow. So if you've been holding the Dow, your drawdown would have not just been these drawdowns here. Look, price and inflation. I divided the Dow by CPI, but I could have done it versus gold, versus silver, versus the other instruments. Practically, you see lower highs, while it did higher, like equal highs here, slightly higher, but testing that breakout line. Lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And it lost, price and inflation in 16 years lost 73% of value. So that's just inflation, Kevin. It's not, another asset class. This is just inflation, just destroyed any holders of the Dow. Of course, yeah, just for dividends, it looks less worse than that. But the lesson is, if you're not in a bull era for stock markets and you're starting to recognize that you aren't breaking out and you're losing these rising support lines, you step aside, you do racial charts, you see what's outperforming, and that's the secret there to sidestep this decades loss, like decades. And it could happen again, guys.
Exactly. And the fact that gold is breaking out versus stock markets as we speak is a big warning sign that it may very well happen again. So everyone watching this should be well aware and well warned of a potential decade or more of problems for the stock market. Okay, everybody, that's great. More incisive stuff from Pat there. So if you like all of that, don't forget to like, subscribe, and hit that notification bell.